The oil war between Russia versus USA and Europe explained. The battle between Russia, the US, and Europe over oil is heating up, and it's affecting not only the global economy, but also the fate of entire nations. In this video, we'll unravel the complex web of alliances, sanctions, and price caps that define this oil war. The background for the oil war between Russia and the West began as a result of Russia's role as a major oil producer and exporter. Russia is one of the world's largest oil-producing countries, and its oil exports make up a significant portion of its economy. However, tensions between Russia and the West began to escalate in 2014 when Russia annexed Crimea and supported separatist movements in eastern Ukraine. These actions resulted in a breakdown of relations between Russia and the West. In response to Russia's actions in Ukraine, the West imposed economic sanctions on Russia targeting its financial sector and technology. However, these sanctions did not directly target Russia's oil exports, which remained a significant source of income for the country. This began to change in December 2022 when the United States and other G7 nations introduced a price cap on Russian crude oil with the aim of limiting Russia's oil earnings and limiting the financial support for Moscow's budget and military. This is not the first time the West has attempted to target Russia's oil exports. In March 2022, the United States, United Kingdom, Australia, and Canada imposed a restriction on imports of Russian oil and petrochemicals. However, these countries imported small volumes, and the impact on Russia's oil exports were minimal. Additionally, the EU had delayed the introduction of an oil embargo passed in June until December 2022, and an embargo on petrochemicals until February 2023. The EU embargo and price cap. European Union (EU) enforced a ban of imports on Russian crude oil by sea as of December 5, 2022 as a measure to curb Russia's revenue from fossil fuel exports and its support for the Moscow budget and military. EU member states are prohibited from importing, purchasing, or transporting Russian crude oil and petroleum products that have been transported by sea. On the same day, the member states of the European Union, the members of the G7, also introduced a price cap on Russian crude oil in an effort to limit Russia's revenue from fossil fuel exports. The price cap is aimed at preventing the Kremlin from replenishing its war chest and funding its military actions. If the cap on oil prices had been set at a low point of $50, it would have negatively impacted Russia's revenue and made it challenging for the country to maintain a balanced state budget. Experts believe that Russia needs prices to be around $60 to $70 per barrel in order to achieve its fiscal break-even point. Even if the cap was set at $50, it would still be above Russia's cost of production, which ranges between $30 and $40 per barrel, providing Moscow with a motivation to continue selling oil to avoid having to shut down wells that are difficult to restart. Robin Brooks, the chief economist at the Institute for International Finance in Washington, tweeted that a $30 cap would give Russia the financial crisis it deserves. The disagreement on where to set the cap demonstrated a difference in objectives, with some groups pushing for the weakening of Russia's economy and others advocating for inflation control, as noted by Maria Shagina, a sanctions expert at the International Institute for Strategic Studies in Berlin. She also stated that the United States primarily focused on curbing the increase in prices. Russia responded by banning oil sales to countries that abide by the cap. But Kremlin spokesperson Dmitry Peskov stated that the price cap would not have a significant impact on Russia's ability to sustain its military operations in Ukraine. He also warned that the measure could potentially cause instability in the global energy market. India has stated that it will continue to acquire oil from Russia, utilizing non-Western companies as a means of obtaining the supplies. However, India's refining abilities for Russian oil deliveries are not boundless. Turkey has seen a substantial increase in the imports of Russian oil in recent months, and is likely to continue serving as a significant center for Russian oil. On the other hand, China's continued growth in demand is hindered by the impact of the recent pandemic and Beijing's commitment to energy security and diversifying its suppliers. Redirecting Russian oil supplies from Europe to Asia would not be a straightforward or rapid process, as it would result in a substantial decrease in profits for Russian companies. The cost of transporting Russian oil to Asian markets is much higher than to Europe, and the limited availability of transport capacity drives up freight costs, which diminishes the profit made by Russian companies, regardless of the ban and the capped price. In addition, the imposition of a cap on oil prices also presents Asian buyers with the opportunity to receive substantial discounts on Russian oil. This has already been seen as some deliveries to China scheduled to be loaded onto tankers in January were sold at $5 to $6 per barrel lower than the standard price. The aftermath of the oil war. The implementation of a price cap on Russia's oil exports by a coalition of Western nations is a significant move, particularly for Europe. The fact that such a measure is being taken is a testament to the impact of Russia's invasion of Ukraine and the severity of the situation. Prior to this event, it would have been difficult to envision such action being taken against Russia's energy exports. The West's imposition of sanctions and embargoes on Russia's oil exports is having a significant impact on the country's economy. Despite Russia's ability to weather previous financial pressures due to its energy exports, the current sanctions are causing the economy to shrink. Additionally, Russia's oil and gas sales are declining, and the government has been heavily taxing those industries to raise revenue, which is not a sustainable solution. The effect of these sanctions highlights the power and effectiveness of targeting Russia's oil revenue in response to their actions in Ukraine. The scenario is likely to resemble the events of March and April 2022, with an initial drop in export volumes, resulting from the disruption of prior supply chains, high level of uncertainty, and issues in the functioning of the oil cap mechanism, followed by a period of stabilization and even a slight increase. Therefore, at the start of 2023, a decrease in both export volumes and production can be anticipated, but with the potential for recovery in both areas. In the long run, it seems that a reduction in revenue for Russia is inevitable. After the introduction of the cap on oil prices, Russia's finance ministry has revised its projected budget deficit upwards, increasing it from 0.9% to 2% of GDP. The ministry anticipates a 23% drop in oil and gas revenues in 2023. However, this projection may be too hopeful as the Russian budget is based on oil prices between $62 and $70 per barrel. Despite the decrease in oil revenues, it is unlikely that the Russian economy will collapse. The decline in 2023 is expected to be similar to that experienced during the pandemic in 2020, and it will not be enough to compel Russia to discontinue its conflict with Ukraine. As experts have noted, there are still additional sanctions that could be placed on Russia, although it is not yet at the level of countries such as Iran or North Korea. However, implementing further sanctions would come with consequences for the United States, Europe, and the global community, as they are already struggling with rising inflation and increasing prices for food and fuel. 1 year into the current conflict, the approach of the United States and its European allies towards Russia and Ukraine has evolved. They have focused on providing advanced military equipment to Ukraine. At the beginning of the conflict, this level of support was unimaginable, just as targeting Russia's energy sector seemed unlikely. The oil war between Russia and the West is a complex and ongoing issue. The introduction of a price cap on Russian crude oil as well as sanctions and embargoes has put a significant financial pressure on Russia. The consequences of this oil war are not only felt in Russia, but also in the global energy market. As the situation continues to evolve, it remains to be seen how the West and Russia will adapt and respond to the ongoing challenges. Thank you for watching, and see you in our next video.